Hi everyone, I'm Paul and welcome to my review of Lesson 3 of ICT's 2022 Mentorship Program. I've had lots of really great feedback about the videos so far, so I'm going to keep doing them and keep that feedback coming. It's really helpful and I appreciate it a lot. Please like and subscribe to the videos and let's jump in. So as always, we'll start the review with just an outline of today's lesson. So this is lesson 3. So in today's video, we're going to go back over the homework, but in much more detail than I did in my homework lesson 2 video. We're going to go through market structure shifts, really go deeper into swing high and swing low patterns. ICT goes into a lot of detail on the order block theory, which he'd said earlier in the video series that he wasn't going to do, which he decided to do, which is really great. So I've done a whole section just on this. And we're going to talk a bit about trading windows and time zones. I'm not really using those so much because I'm doing crypto, but I've just outlined those in the video and in these slides for anyone that is going to be trading some of those index futures, just like ICT is, because obviously that's a core part of that methodology. And then I'll also go through the trade that ICT went through in the video, which is the NASDAQ from the 25th of January 2022. So lesson 3 starts with a review of the homework from lesson 2. Now I did a separate video on the lesson 2 homework, but we're going to go into a lot more detail on that in this video. So starting with the 15-minute chart, remember we had these old lows marked out, which we use the 1-hour chart for, and then in terms of the highs, we had this equal highs here set out, but there was also a higher high which we could have used back here as well. And remember, we've marked up the chart like this just to show us where the liquidity is going to be residing. So at these equal highs up here, we have buy stops. So remember, retail traders are going to be seeing these levels as resistance. They'll be going short here and setting their buy stops above that to close out if the trade goes against them. Conversely, on this side down at the lows, we have traders going long at these levels, seeing that as support, and then obviously putting their sell stops below that to protect themselves if the trade goes against them there. And so in both cases, we have the market running down into these sources of liquidity before going in the other direction. And then when we came back up into these buy stops here, this created this area of interest, which is where we're expecting to see a market structure shift. Now, ICT goes into quite a lot of detail in terms of market structure shifts and breaks in market structure. Now, he says you can use those terms interchangeably, and the important thing is here is because we're dealing on an intraday time frame, we're not talking about a change in market structure on a high time frame. So it's distinctly different. All we're looking at is an intraday change in market structure, so the market structure changing, or there's a shift in market structure. So in this example, we go from a downtrend to an uptrend, but that doesn't necessarily lead to a change in trend at a higher time frame. What we're talking about is the market drawing either higher or lower on an intraday basis. And so it's at these liquidity grabbing points that we have here at these sell stops and buy stops is where we're anticipating there's going to be a shift in market structure, and you can see that from this area of interest here. We have the run up into those buy stops, we have the market structure shift, and then the market goes bearish and starts to trade lower. So zooming in now to the 2-minute chart, we're going to look much more closely at those liquidity grabbing points. The first one we're going to look at is that push lower that runs down into those sell stops. So this is a zoom in of that particular area here. So if you remember, we had that previous low, and this was the run down into that particular zone. So one of the important points that comes out of ICT's video is that as we run into this lower low, or as we proceed down into this lower liquidity grab, before that we have this short-term high. So we have this swing high pattern here. Now, the details of this is the swing high is a 3-candle pattern with the middle candle having the highest high of those 3 candles. So you can see that here. So we have this candle, the candle in the middle, and you can see it has this higher high here than this one and the one to the side of it. And so that's our short-term swing high. And we want to see that prior to going into those sell stops, into that grab for liquidity. That's quite important. And so what we see happening after we have this push down into these sell stops, this grab of liquidity, we have these candles push up. And this one in particular is of interest because we can see the body of this candle breaks the high of the swing high. Now, The important thing about this is this candle doesn't have to close above that high. It just has to trade above it. So even if the wick is above this point here, then that becomes significant. So it becomes significant because we've obviously made a higher high. So this high is now higher than this one. But because it's happened in this particular pattern where we've had a swing high, a run down into liquidity, and then a new high immediately after. So this signifies that liquidity has been taken out of the marketplace and we've got a market structure shift. So we've gone from bearish to bullish market structure. And you can see these patterns all coincide with our fair value gap forming. So as the market runs down into liquidity, we have these series of candles here. So we have our fair value gap pattern form, so our 3 candle pattern. So the first candle, the second candle which breaks market structure, and then the third candle which creates our fair value gap. So that's the fair value gap that forms in here. And so you can see its proximity both to this grab of liquidity down here at the lows and this swing high here. And this is all confirming of that change in market structure or that market structure shift. And you can see that if we wanted to go long at this particular point, we have this down close candle here, and the next candle immediately trades into this zone, and that would have been our trigger to then go long. And as before, with a fair value gap, you can do that in a number of ways. You can either be waiting to trade at market, or you can have your limit at the low of this candle, and then your stop would be either at the low of this candle or this candle. Obviously, in this example, you would have your stop at the low of this candle. And so how do we know that we have a bullish market structure shift? So what I've done is create this little checklist here so that you can always run through this as you're going through your setups and making sure that you have that market structure shift if you're intending to go long from that particular signal. So what we need to have first is a push lower or a stop hunt into liquidity, so going after those sell stops. So that's what we had happen here. We have a swing high candle pattern which precedes that push lower into liquidity. You can see we had that pattern form just here. And does the candle break the high of the swing high? And that's what we had happen here. So this candle breaks the high of this swing high here. And does the next candle create a fair value gap? Yes, it does in this example. The next candle here is this down close candle, which creates our fair value gap here in our 3 candle pattern. And does the following candle trade into that fair value gap? Yes, it does. It trades into that fair value gap here, and that allows us to get long. So there are 5 sort of points on the checklist to confirm that we have a bullish market structure shift. So on the flip side, we have a run into the liquidity at the previous highs. So we had these equal highs up here, remember? And then we have this run up into this liquidity, so seeking out those buy stops. So remember, we have people going short here, they're setting their buy stops above here to protect themselves if the trade goes against them, seeing these consecutive highs as resistance. So the market runs up into these highs to take this liquidity, and then we have our change in market structure. So similar to our liquidity grab at the sell stops, as we have this run up into liquidity here, we have this short-term low form. So similarly to our swing high, this is a swing low pattern. So we have a 3 candle setup with the middle candle having the lowest low of the 3 candles. So that's our short-term low that's formed just there. Following that swing low, we have the next candle which trades lower than the low of the short-term low. So this creates a new lower low. And the candle after that then completes the setup and creates our fair value gap. So we have our 3 candle pattern again, and the fair value gap forms between the low of the first candle, the high of the third candle across the body of the second candle, and that's where our fair value gap's formed. The next candle afterwards trades back up into that fair value gap where we're able to get set short before the market trades lower. So do we have a bearish market structure shift? So I've created a checklist just as before to go through to make sure that the setup that we're entering into does have a bearish market structure shift so we can catch that down move. So do we have a push higher or a stop hunt into liquidity into those buy stops? So yes, we do. We have this run into these equal highs, the push high into liquidity, which is attacking those buy stops. And in concert with that, do we have a swing low pattern? And so yes, we do. We have a 3 candle pattern here. So we have 1, 2, 3, and with the center candle having the lowest low of those 3 candles. And so does the next candle break the low of that candle? Yes, it does. We have this powerful push lower, so this candle creates a new lower low, and this low is lower than the low in the swing low pattern here. And so then does the following candle create a fair value gap pattern? And again, yes, it does. So this next candle closes higher, and so we have a fair value gap formed. So we have our 3 candle formation. So we have the first candle, the second candle, and the third candle. And so the fair value gap is formed between the low of the first candle and the high of the third candle across the body of the second candle. So we have that fair value gap pattern formed. And then the next point is, does the candle after the fair value gap trade into that fair value gap? And so yes, it does. You can see this candle here, before it trades lower, trades up into that fair value gap, and then the market obviously has shift to the downside. We've got a bearish market structure shift, and it trades lower after that. So I found this part of the video really helpful. It really consolidated in my mind sort of what I'd been anticipating about what ICT had meant about changes in market structure or market structure shifts up to this point. And so the way I sort of look at it now in my mind, when we're looking at either these setups to go long or short, we have these bullish market structure shifts or bearish market structure shifts, the market changes gear. So if we look at this push lower initially, we have all of the requirements that we need for this change in market structure. So we have a bullish market structure shift. So the market is going to attack these previous highs where we know that there'll be buy stops residing, and it'll also attack those imbalances, so these bearish market imbalances. So you can see we have these fair value gaps that are formed here. And so when we have this bullish market structure shift, the way I think about it, the market's kind of changed its vector. So it's now gone from being in this bearish downtrend to a bullish uptrend. And when it's in that mode, it's going to attack the stops that reside at these highs. So it's going to attack these previous buy stops as it starts to trade higher. And it's also going to attack these bearish imbalances. So these fair value gaps that are formed as the market has traded downwards, as the market changes in market structure, so it shifts to this bullish market structure, it's going to attack these as it goes higher, obviously, until it runs up into a previous set of highs like it did here, and it goes then deep into these previous highs, into this liquidity, and then it changes its market structure again. So just as before, we have a bearish market structure shift, so the market's changed from bullish to bearish, remembering this is all intraday, this is not at a higher time frame, and so the market is then going to attack these sell stops that are residing below these lows. It's also going to attack these bullish imbalances, these bullish fair value gaps that have occurred as the market has traded higher. So price is going to attack those bullish imbalances, or those bullish fair value gaps were formed on the way up. As the market structure shift occurs here, and we have that bearish market structure shift, it's going to attack them again on the way down. So I think the other thing that's really helpful about thinking about the market in terms of these market structure shifts, in this example where after we've had these run into these highs and the bearish market structure shift, we know that price is going to attack both the sell stops and the bullish imbalances on the way down. And so we can then use those as targets when we're looking to exit the trade. So I found all of that clarification from ICT's video really helpful. I think this sort of deeper detail on some of these finer points was really useful, and it really consolidated some of my thinking and understanding about what we'd previously been discussing about market structure shifts. So we're really fortunate that in lesson 3, ICT goes into order block theory. He'd sort of said in some of the earlier videos that he wasn't going to cover order blocks in the mentorship program, so it was really great that he did. I've been using order blocks before in my trading, and so it was really interesting to get this deeper dive into that, because I've probably not been using them exactly as he taught it here. So it was really helpful to get that clarification. And so what actually is an order block? So ICT states that the order block signifies a change in the state of delivery in the market. So we've already been talking about market structure shifts. And so order blocks are obviously another tool that we can use to signify a change in the state of delivery in the market, or a change in market structure. And so the way I've interpreted what he taught in this lesson is that a bullish order block signifies the market switching to bull mode. So we kind of talked about that at the end of the homework just before. And so price will hunt buy stops and bearish imbalances or fair value gaps. And a bearish order block signifies the market switching to bear mode. So price will hunt sell stops, bullish imbalances, and fair value gaps. And so what does that exactly look like? So let's start with a bullish order block. So you can see here from the diagram, so this is lifted from ICT's lesson, is that we have the 3 consecutive candles in this down move. So this is from the push lower into liquidity, so the push into the old lows. So the 3 candles are one continuous order block. And so the important part of the order block is it resides inside the pool of liquidity, so the sell stops, and prior to a fair value gap. And I think this is the thing that in my use of order blocks previously that I wasn't aware of, or hadn't been taught to me, is that fair value gap also has to be present for the bullish order block to be valid. And so the change of delivery occurs when the open of the first black candle is breached. So the open of the first candle in that 3 candle formation is what we're talking about. And that's breached by that 3rd candle, the 3rd green candle, as it travels higher. So you'll notice that the candle that we're talking about, which is the first candle in the order block, is also the high of the swing high pattern, or that short-term high. And that's then breached by that 3rd green candle to create the new higher high. And so this is where a change of delivery occurs. This is where our shift in market structure occurs. So what this means is that price switches from being bid lower in the market to the price being offered higher in the market. And so if we wanted to use this bullish order block as a setup, we would use the open of that first black candle as the limit for our buy order, and we'd put our stop at the lows of that formation. As you'd expect, the bearish order block is just the converse of our bullish order block. So in this example, we have 2 green candles, and these are our one continuous order block. And so as before, they reside in a pool of liquidity, in this case buy stops, and again prior to that fair value gap forming. And the change of delivery is going to occur once the open of that first green candle is breached. So this is that low. And so what this means is that price is going to switch from being offered at a higher price in the market to being bid lower. So it's obviously the opposite of the bullish order block. And so if we're going to use this bearish order block as a setup to go short, we would use the open of that first green candle as our limit for the sell order, and then we would put our stop at the highs. And so finally, we'll just cover trading windows and time zones. So ICT setup is mostly using index futures, so he's used the S&P and the NASDAQ to date, and so he's using New York time as his base. So that's his basis for everything he's looking at, and New York time is a key part of his whole setup that he's teaching. So ICT's setup primarily centers around trading in that New York morning trading session, and he recommends avoiding that lunch session, so that sort of 12 to 1 part of the session, because that can be problematic. And so he uses then the other session, so the London and the Asia session, as a way of mapping out the highs and the lows, which he's going to use as a reference point to then trade in that New York session. So this New York morning trading session is very fundamental to the whole setup that ICT's been teaching so far. So because I'm trading the cryptocurrency markets, this isn't as relevant to me, or I haven't found it as relevant in my testing so far. And so what I'm hoping to try and figure out is there a similar time frame that I can use to create the same setup and then just create that daily opportunity, just as ICT's done for that New York trading session. So once I've done that, I'll share that in other videos and hopefully track the progress of that trading. So apologies, my data doesn't go back far enough to look at a 1 minute chart for this NQ trade on the 25th of January, but it's not really that important because there's really only a couple of things to take out of that particular part of the video. And if you obviously want to watch that, go to ICT's channel and watch this particular video live if you want to replay it yourself. The main thing to take out of the video is then when there's a setup with 2 fair value gaps, so you can see from the diagram there, there's actually a lower fair value gap after the sweep of the lows, and then there's a subsequent fair value gap, which is the green box higher than that. So ICT talks a lot about when there's two fair value gaps set up like this, you want to allow the market to trade lower into the lower one, and then you want to use the higher one as your entry. And so this is a high probability setup. So obviously, if you were looking at going short, the reverse would be true. You would have a higher and a lower one, so you would want to see it trade into the higher fair value gap first and then enter on the lower one. And then for the exit, as we talked about in the rest of the video, we've got this bullish market structure shift. And so as a consequence of that, we'll be looking for sell stops, and we'll also be looking for bearish fair value gaps or imbalances as our exit. And in this example, we're going to be targeting the bearish fair value gap, which is the pink box. And so the other important thing to take out of this particular example or this setup is that just keep in mind we're always looking for the low-hanging fruit on these particular trades. So we'd be targeting the lower edge of that fair value gap as our exit. So there you go. There's my review of lesson 3 of ICT's 2022 mentorship program. I hope you found that helpful. If you enjoyed this video, it'd be great if you could like it. That'll help other people to find it. And if you'd like to keep following me on this journey through the mentorship program, please subscribe to my channel, and I'll see you in the next video.